Welcome to the Intermarket analysis video update. This is a video that I do once a week where we look at other markets outside of just the S&P 500 to see if we can get any clues as to what's happening within the S&P 500. This is being prepared for Monday, June 9th. Before diving into today's video, if you find it helpful, consider a 30-day free trial to the SPX investing program. This trial lets you explore my unique approach to market analysis. Full-length daily and weekly videos are available on a delayed basis after the market closes. For immediate access, become a member by clicking on the link below. Now, the first area that I'll go through is valuation. We look historically at past earnings reports and apply them to what the price of the S&P was at that time, and that gives us the price to earnings ratio. And then we put that on a scale of 10 to 20. That is considered to be fairly priced, with 15 being right at the middle. If we go below 10, we're considered inexpensive. We go above 20, we're considered to be expensive or overvalued at that point. And then I look at forward-looking PE ratios because that's what the market uses to justify prices going up or down. Then we go through an extensive look at growth versus value. We want growth to do better than value when the market's going up. If value starts to do better than growth, then we get a little concerned, and that's usually when the market's either going sideways or down. We keep an eye on inflation. The market's always worried about that. And then we look at some other markets that we don't really talk about other than in this video, and I don't really look at them other than when I'm preparing this video. Then there are 11 sectors that make up the S&P, and we go through each sector individually and then compare it to the S&P 500 to see how well it's performing. We look at some indexes across different stocks. And then we look at correlations between stocks and bonds, stocks and oil, interest rates with the tech sector, things like that, just to see if we can get any insight that way. We look at some very long-term trends. And then at the very end, I go through a list of positive things and those that are negative. Now, it doesn't cover everything that I go through in this chart. I just break down the ones that really seem to apply to the S&P 500 the most. All right, so let's look at valuation. This is looking backwards at earnings reports that have already come out and then what the price of the S&P was at any given time. And using that 10, 15, 20 scale, you can see we're well above the red dashed line, which should be at 20. If we were to come down and be not expensive anymore, the S&P would have to come all the way down to 4,200. Well, we closed at 6,000 on Friday, so that would be an 1,800 point drop, which would probably not make a lot of people very happy. But this just gives you an idea. Now, I don't use this to make decisions. We've seen this overvalued for years now, and if you tried to use this to make some kind of decisions, you would miss out on a lot of gains because the market spends a lot of time above the red dashed line. And this is that same thing, but going back with different events that have happened and what the valuations were at that time. And Robert Shiller did a variation of this to try to make it more accurate or more realistic. He looks at earnings over a 10-year period of time and then works that out into what's called the Shiller PE ratio to try to get rid of outliers or strange events to see if we can get more of an average. Well, the latest reading here is coming in at 36.91. Okay, you can see on the chart that we've been really going up as the market has been going up. The market's been becoming more and more overvalued all the time. Well, we also look at the median and the mean. Well, now for the last few years, this has been between 16 and 17, and we're coming in at 36. So we're more than double what the median and the mean is of this chart, meaning that this chart is also suggesting that we're overvalued, but we've been this way for quite a while. All right, the market looks forward, though, with earnings that haven't come out yet. These are forward projections based on and now analysts, what they think is going to be the earnings, and then they kind of put them together and average them. Well, the purple line here is the Mega Cap 8. Sometimes we call it the Magnificent 7, the Illustrious 11, whatever. On this chart, it's broken down into 8 stocks, and we still use the 10, 15, 20 scale, but right now we're coming in at 27.6. So yeah, these are considered to be expensive, but this is Apple, Google, Nvidia, stocks like that, stocks that people really like to own. And so they're willing to buy something that's already considered to be expensive with the hope it will become even more expensive by going up in price. Now, the S&P is above 20 right now, coming in at 21.5. That's the red line, and that's what I focus on the most. And then since we've been bouncing up after going down in March and into April, we're actually getting a little bit above 15 here. We're right at 15 with the small caps, and we're at 15.9 with the mid caps. But do these stocks have the earnings to justify their price going up? With interest rates going up, usually these smaller companies get hit harder because they have to borrow a lot of money and they can't absorb these things like bigger companies can. And so that's why we've been seeing them lag behind quite a bit. All right, then we break it out on the 11 sectors, comparing it to the S&P itself, where when this chart was taken, we were at 21. There are some sectors here that are even more expensive than the S&P itself, like staples, but they didn't have a great week. Industrials, tech, this is a growth area, and discretionary. Now, discretionary didn't have all that good of a week either, since Tesla is part of discretionary, and it got hammered over 14% on Thursday. It got over 3.5% of that back on Friday, but still, it's really been dragging the discretionary sector down. But you can see these sectors are above 20, 22, 24, 27, 28. Now we have some other sectors that are actually cheaper than the S&P, with energy being at the very bottom at 15. Then we look at growth all by itself, where it's still in a downtrend. We have the 50-period moving average below the 200, but price is above both of the moving averages, and now both of the moving averages are still going up. So if we can stay above these moving averages here, we will probably see a golden cross, which would mean we switch from a downtrend into an uptrend pretty soon. Then we look at peer value. This is actually chopping more or less sideways. And in a more positive environment, I go back to this chart, we want to see this going up more than what we're seeing value going up. We don't want necessarily anything to fall apart. We just want growth to be outperforming value. Now, where we get some insight is when we do ratios between the two. This one shows growth outperforming value, and this is more positive for what's been happening in the market. And then I do an inverted version of that same chart, just in case we get some additional insight that we don't see by looking at the single chart by itself. This shows how value is underperforming growth. Then we look at a growth ETF versus a value ETF, showing how growth is outperforming value and in an uptrend on this chart. And this shows how value is underperforming growth. And we look at some indexes. Growth is also outperforming here. Value is also underperforming here. Then we break it out and look at the small caps, where even though the small caps haven't been doing all that well, this is the small cap index that I follow here. It's the S&P 600. It's been just kind of chopping along sideways. It did have a good day on Friday, but it really hasn't been moving all that much. But when you look inside and you compare growth to value, growth is actually doing better. So this is more positive for the small caps. We're also looking fairly positive with the mid caps, even though they've been chopping sideways too. What we really pay attention to is S&P growth to value. That affects the S&P 500. And we're above both of the moving averages, and we're getting close here to a golden cross where we would switch from a downtrend to an uptrend. So this is looking better too, and this is more positive for the market. And we look at a growth to value ETF and do a ratio. We're above the rainbow, and even though this isn't really busting out to the upside, it is holding on to gains that it had been getting. And then we show here how value has been underperforming growth with those same ETFs. Then we keep an eye on inflation. This is a monthly chart of the CRB index, which we're above the moving average, and the moving average is going up. So longer term, the CRB index is positive. We want to keep an eye on that because the CRB index, those are commodities. And if those prices continue to go up, that might be inflationary. Now, we just started a new month, and so we finally clicked over into the next part of this chart. We look at a ratio between inflation and deflation, where we're still going down with the moving average longer term, but we are coming right back up to the moving average. Now, we'll keep an eye on this, but this will take a number of months to actually play out. If we cross above the moving average and then the moving average starts to turn up, that could mean that inflation is actually outperforming deflation. Here's a daily chart of the CRB index, pulling back, but still in an uptrend. and it's still above both of its moving averages. We look at the Baltic Dry Index. As a general rule, when this is going up, that's more inflationary. When this is going down, that's more deflationary. And we're just barely starting to see an uptrend here with this. And then we look at inflation expectations. This is a weekly ETF where we had been going up, and that was causing some concern. Well, lately it's starting to roll over a little bit. So this isn't really suggesting there are real inflation problems according to this chart. Then we look at that same chart of inflation expectations and do a ratio with TIPS, Treasury Inflation Protected Securities. If investors are concerned about inflation going up and interest rates going up, they get into TIPS. If they're not concerned about interest rates going up or inflation going up, they get into government bonds because you can lock in that rate. TIPS adjust their interest rates, and they're also shorter in maturity, so you can roll them over and take more advantage of a changing environment. Where if you think interest rates have topped out and are starting to come down, then you would jump over into government bonds. Well, not really anything all that drastic is happening right now. We were going up as stocks were going down, but now this ratio is starting to come back down, suggesting that really inflation is not a problem according to this chart. Then just to keep an eye on some other markets. This is aluminum, which is in a downtrend. That's not inflationary. Corn is still in an uptrend, but it's falling back to its 200-day moving average. Wheat is in a downtrend. Overall, that's not inflationary. Fertilizer had been going up. That was causing some concerns. Lately, it's been starting to pull back. Lumber, which is in an uptrend and kind of falling back, but it's come back up to its 50-day moving average. Oil is in a downtrend. Now, it was announced this week that OPEC is going to increase their production in July, and that's probably helping to keep oil prices down. Now, oil prices can also go up if something erupts in the Middle East, and oil prices might close the Strait of Hormuz, or shipping oil to the U.S. might become a lot more complicated. So we keep an eye on this, not only for the direction of how oil is going, but in case something geopolitical actually happens. The gold to oil ratio, gold's been doing really well. It's been outperforming oil, but lately gold's been going sideways and oil's been not really going all that far up or down either. So this ratio's been going sideways. Then we look at oil, which is the red dash line, and then the 10-year yield, which is the black line, and they're starting to get stronger. You can see they're generally starting to go in the same direction, and the correlation at the bottom is picking that up. We're neutral right now, but when we go above this blue line and go up and up and up with the correlation, that means they're going in the same direction at the same time. Gas is still hanging on to a very slight uptrend here. The blue line hasn't quite crossed below the red line. Heating oil's in a downtrend. Of course, we're coming into the summer months now. Natural gas is still in an uptrend, even though it's been pulling back lately. And we keep an eye on diesel, which overall has been declining lately, so that's not inflationary. Copper, and we look at this because this can be used as a general barometer for the economy. If the economy looks good, copper tends to go up. If the economy is not looking very good, copper tends to go down. Well, it's in an uptrend, pretty solid uptrend. Even though it declined on Friday, the 50-period moving average is quite a bit above the 200-day moving average. So we are looking pretty solid there. Then we look at our copper to gold ratio, which really goes down when gold has been outperforming copper. Even though gold has been going sideways, and we saw copper doing a little bit better here, but still overall this ratio is going down. This is that same thing, but looking longer term and also plotting the 10-year and the 2-year yield on here. For a number of years, they tended to get going in the same direction at the same time. We've seen a real disconnect over the last few years. Not quite sure why that is. It's been happening for quite a while, but the overall climate of the market has been changing ever since the COVID lockdowns and everything, where we're seeing interest rates going up to higher levels, and we keep seeing this ratio continuing to go down, meaning gold is outperforming copper. Here is gold, which has been kind of chopping around all over the place, but is still in an uptrend. And then Thursday and Friday, silver really broke to the upside and is looking pretty solid in an uptrend there. And we look at a gold to silver ratio, which gold has been going sideways and silver's been going up. So we see this ratio going down. That means silver over the last few days has been outperforming gold. And then we plot the US dollar index down below, and the dollar's been pretty weak lately. Well, we can see as this ratio is going down and the dollar's been going down, we can see that this correlation is actually getting stronger, meaning they're going in the same basic direction at the same time. The dollar under pressure, under 100, in a downtrend on the daily chart. It's also in a downtrend on the weekly chart. Then we look at the euro, which is in an uptrend compared to the dollar. We also plot that with the Japanese yen, which is in an uptrend with the dollar. Then I break these out here. This is the euro to the dollar. We're showing it's outperforming. This is the yen, which is in an uptrend compared to the dollar, and the British pound, which is in an uptrend compared to the dollar. Mastering the stock market is challenging and can take decades to achieve. Most beginner traders and investors feel overwhelmed and often fail. Stay ahead with the SPX investing program. Members gain access to the full program. Other options include immediate access to videos as they become available. Alternatively, the daily and weekly newsletters may be helpful. Click on the link below to find out what's best for you. Then we look at different index ratios. We compare the weighted version of the S&P, that's the bar chart, with the red line, which is an equal weight, where all stocks are treated the same. Now we're seeing a little bit of a disconnect here, where the S&P has been going up and the red line's getting further away from the bar chart. Usually when they're going more hand in hand with each other, we see the red line a lot closer to the bar chart, even though they're on different scales. So we want to keep an eye on that. What we've been seeing lately are the big stocks, the mega caps, have been doing a lot better. And that's what really tends to drive the markets up. And if they're getting ready to go up, that'll be more positive for the market. But it doesn't necessarily mean all of the stocks are going to participate in that. And I'll try to point that out as I go through some charts. This also shows how the equal weight version has been underperforming the S&P. When this ratio goes down, that means the equal weight is underperforming. Then we look at a ratio between stocks and commodities. Now, longer term, I don't show a really long-term chart, but longer term, stocks are outperforming commodities. But here, we're seeing pretty much going back to the beginning of 2025, where stocks have been underperforming commodities, but now they've been starting to come back up, even though we're still in a downtrend. This is that same thing, but using an inverted version of the chart, how commodities were outperforming, now they're starting to underperform. We look at the NASDAQ 100, which is growth, and compared to the S&P 500, which is both growth and value. And in a more positive environment, we want to see this ratio going up. And we just generated a golden cross here with this ratio. That's more positive for the market. We look at the biggest stocks that make up the S&P 500. That's the S&P 100. And when they're outperforming, this ratio goes up. The NASDAQ has been outperforming the S&P. The NASDAQ tends to be more growth, where the S&P, again, is more growth and value together. So this is more positive when we're above the moving averages and going up. The NASDAQ 100, kind of going sideways lately with the NASDAQ. Both have been doing okay. We're not really trending right now, either with the NASDAQ 100, the NASDAQ, or the S&P. We've been really chopping sideways, and we're starting to see this ratio going sideways as well. Now, this is where we're seeing some improvements. These are the mega caps, the stocks that everybody hears about and everybody wants to own. They are really starting to outperform the equal weight version of the S&P. In fact, we're generating a golden cross here. So we're seeing much improvement after really coming down in March and into April. Small caps still struggling. Even though they had a good week, they really haven't broken out or anything yet. They are struggling when compared to the S&P 500. This is that same chart. The red line is that ratio we just looked at. And you can see how this ratio has been going down for quite some time. And the blue line, that's the S&P, where it's been holding up a lot better. And we look at the robotics and AI ETF, kind of chopping along sideways, but at least holding up inside of this rainbow. But when we compare the robotics and AI ETF to the tech sector, it's actually underperforming, which is strange because AI is all the buzz these days. Now, there's another index that I'll show you here in a moment that might help. Then we look at the mega caps all by themselves, where they really took a dive. They've really been coming back, still in a downtrend, but the 50-period moving average is starting to come back up to the 200, and we're above both of the moving averages. So this is really improving here. Then the Dow Jones Composite, which takes the Dow, which can't seem to stay much above its 200-day moving average lately. The transports, which have been struggling, and the utilities, which have been pretty much going sideways, can't seem to get above the 200-day moving average with the Dow Jones Composite average. It's not falling apart, but it's not showing an awful lot of strength now either. Then we look at the small caps to tech here, showing how small caps are underperforming. Then this is kind of important. And I know semis had a good week this past week, but when you look at the semi to tech ratio, we want this to just blast up here with this ratio. That means the semiconductors are outperforming the tech sector. The tech sector can still be doing well. We just want the semis to be doing even better. Well, they did improve lately, but they really haven't broken out yet. We've just kind of gotten back to the high end of this previous spike up that we saw. Then we look at low volatility stocks, which are in an uptrend by themselves. These are the stocks that the market gets into when it's getting ready to go down. It's still holding up okay, but been doing a lot of chopping sideways. But when you compare it to the S&P, it was really outperforming when stocks were going down. Now it's underperforming as the S&P's been going back up. All stocks against, we take out the stocks, all world stocks, we take out stocks from the US, they're doing pretty well. Global stocks right now are outperforming US stocks. Now, is it going to stay that way? We don't know, but they've been doing a lot better so far in 2025. Now, when we do put the US stocks back into the mix, that's when this ratio starts to go down. That means that US stocks are underperforming stocks in the rest of the world. And we look at growth stocks and compare them with bonds, starting to see a golden cross here as growth stocks are outperforming bonds. That wasn't the case when we were really going down. The energy sector to the tech sector, this is going down. That just shows that energy is underperforming tech. We were going up as stocks were going down. Now this ratio continues to decline. Then the tech sector to the 10-year yield, still in a downtrend here, but really chopping along sideways, but not really falling apart. This is that same thing looking at the 10-year to the tech sector, where the 10-year yield's in an uptrend compared to the tech sector, but it's been pulling back lately. Discretionary to staples. This is an area that's still struggling, and a lot of that has to do with Tesla, where we were really outperforming back in late 2024. The discretionary sector was the strongest sector in the market. Well, then it took a dive with everything else and is having a bit of difficulty getting back up with this ratio. It's in a downtrend. It has been improving, but we want this ratio to really go up. This is kind of like growth versus value. Discretionary, things that make life fun, versus staples like toilet paper and toothpaste, the things that you have to have. Then looking at that same thing but inverted, showing how staples were starting to outperform going back to the beginning of 2025. Now they've been pulling back. Gold to the S&P. Gold was really outperforming, especially as the S&P was going down. Now we're starting to see this ratio decline. And then gold to the dollar. Gold has been holding up. The dollar's still under pressure. Not really seeing a big change in the ratio, at least lately. Then we look at the advanced decline line, and I show this in the daily video, and we're above all the moving averages here. When we look at the NYSE common stock, the S&P 500, the mid caps, and the small caps. So not really breaking out and setting new highs yet, but we are holding up with these advanced decline lines. We look at a ratio between the Dow and the transports. When this is going up, that means the Dow was outperforming the transports. We look at the transports all by themselves. They took a dive with everything else. They have been bouncing back up, but lately we've just been kind of range bound here. And then we look at another ratio between the Dow transports and the S&P. When this is going down, that means the transports are underperforming. But we can see that the correlation between the two is fairly strong. So if the S&P is going up, generally transports are going up. It's just that the transports are going up less. All right, then we look at traditional Dow theory, which looks at the Dow up here on top, and then the transports. And then I also include utilities as part of your traditional Dow theory. And we're improving here with the Dow. We're showing a little bit of improvement with the transports, but we've been chopping sideways, but gradually going up here with utilities. And instead of using traditional Dow theory, we swap out the Dow and put in the S&P 500. And instead of using the transports, we look at the NASDAQ. And this has been really improving since we took that dive back in April. Then we break this down even further. Instead of using the S&P, we use the equal weight version, which did not make an all-time high back in February. The S&P weighted index did. So this is still a longer-term negative divergence. But we are coming back up with the equal weight version of the S&P, and we're going back up. Instead of using the NASDAQ, we use an equal weight version of the NASDAQ 100, which are the QQQs. And both are showing some improvement here. Here's a daily chart of the Wilshire 5000 in a downtrend, but still above its 200-day moving average. Total U.S. stock ETF, pretty much the same thing. I used both of these charts to get a broad market look at stocks. Then the FANG index. This is why I'm saying maybe the big stocks are starting to kick into gear. This is Facebook, Apple, Amazon, Netflix, Google, Nvidia, just generating a golden cross and really doing well, setting an all-time high here in Friday's session. And then ARK, it's above both moving averages, and it had a pretty good week, and it had a good day on Friday, up 8.5%, but it's still in a downtrend. The NYSE composite in a downtrend, but it actually held up better when we were really going down. It went down too, but it went down less. And even though it's in a downtrend, it's above both of the moving averages. The micro caps, really small companies here, in a downtrend, but also improving. All stocks, which looks at U.S. stocks and international stocks. And really the strength that we're seeing here is coming from the international stocks. Now, we're not in an uptrend yet, but you can see both moving averages are now starting to go back up. So we're seeing some improvement here and setting an all-time high with this particular ETF. Emerging markets in an uptrend. That seems to be doing better these days. High leverage loans. Again, this is another barometer of the economy. We're doing quite well here. If the economy was getting ready to fall apart, this would be going down, not up. The Japanese Nikkei is still just kind of chopping around below this red line, which are the highs set way back in 1989. And then we look at the semiconductors. This is a huge part of growth. Now, they're still in a downtrend, but they're above both moving averages. A lot of sideways action in here. We're watching to see, are we finally going to be able to break to the upside and turn even more positive? Then this is that same chart, but I use a rainbow here where we're starting to break above the rainbow. Then this is the other ETF, the AI and tech ETF, which is in a downtrend, but both moving averages are going up, and we're seeing some improvement here. Then we want to keep an eye on the home builders. We have the S&P on top, the home builders ETF in the middle, and then the correlation. Coming down a little bit here, but we're still seeing that the correlation has been pretty strong lately. Then this looks at world stocks, and I use the KST as a momentum oscillator here. We're pretty much flat and possibly rolling over in China. Starting to see a downtrend, though, in emerging markets. Starting to roll over a little bit, but trying to still go up here in Europe. Europe stocks have been pretty strong so far in 2025. Rolling over a little bit, but still going up in Japan, and rolling over right now with the longer-term KST in the U.S. So are we going to see some kind of a pullback that maybe the market just thinks, oh, we're magically going to go up? Well, this tells us to be aware of that. And this is a longer-term oscillator that we use to measure the trend. And Bitcoin is in an uptrend now, even though it's been pulling back. It broke above 100,000. It's still there, but it came down to its 50-day moving average. Then we look at another ratio between U.S. and world stocks, still holding up okay longer term. This is a monthly chart, and we dropped below the moving average. Now we're still going back up here, and the moving average is still going up. But when you look at the momentum oscillator, the PPO down below, it's declining here. It was picking up this decline that we've seen so far in 2025. Then we look at bonds based on price, where we had been going up, but they really dropped in Friday's session. We're above 4.51% with the 10-year yield, and that's where stocks can often get concerned and start to go down. So we'll be keeping an eye on that. But we are still in an uptrend with the total bond ETF. And then we now started a new month, so we clicked in for May with the stock to bond ratio monthly chart. And so far, we've been starting out pretty good here in June. So this ratio is really improving. And we were starting to go up, showing bonds were outperforming stocks when stocks were going down. Now we're just seeing that reverse right now. And then we look at investment grade bonds. These are more conservative bonds. They've been chopping more or less sideways, though. And then corporate bonds, which are in a downtrend, but we're still above both of the moving averages. And then junk bonds, and these are doing quite well. They tend to follow the stock market, and they're in an uptrend. They went down with everything else, but they've been bouncing back nicely lately. And we look at world bonds, which it's really hard to see because they've been so choppy, but we are starting to go into an uptrend here. And then a stock to bond correlation, fairly strong correlated relationship, meaning the price of bonds and the price of stocks tend to go the same way at the same time lately. And then this is the 10-year yield, showing how we've been establishing that higher range, different than what we saw over the last 40 years. And then here's junk bonds. which are also doing quite well. And then we do a junk bond to government bond ratio. And when this is going up, that means junk bonds are outperforming. We look at riskier bonds. Now we're below the rainbow, but we are improving. When we get above the rainbow, that's more risk on. That means the market is more confident that it's going to continue to go up, and they would rather get into junk bonds to give a higher yield than more conservative bonds. So we're seeing an improvement here, but it hasn't really shifted over to what we were seeing earlier on when we were well above this rainbow. And here's a daily chart of yields just showing how they've been going up and down and all around lately. Here's a weekly chart of international bonds, bond yields anyway. I was really focusing on the red line, which is the 10-year yield in Japan. It's going up. It went down this past week, but it doesn't seem to be causing the problem like it was causing last summer. Then we look at the volatility of bonds, the MOVE index. Bonds have been coming down as far as volatility. And we look at the volatility of stocks. That's the VIX. It's been coming down lately. And we had been neutral with the relationship between the top chart and the middle chart. It's getting a little bit stronger now. Then we look at some ratios between stocks and bonds. This is the S&P 500 to short-term bonds. And when this is going up, that means the S&P 500 is outperforming. Then we look at 3 to 7 year bonds and compare them to stocks. So this is the inverse of what we just saw, only further out bonds, where bonds were really starting to outperform, but lately they've been going back to underperforming. Then we look at the S&P 1500 to short-term bonds coming out of the rainbow. Another broad market measure with further out bonds coming up out of the rainbow. So we're seeing confirmation there. The tech sector coming up out of the rainbow when compared to 3 to 7 year bonds. And then we look at the S&P to the 10-year yield. We're in a downtrend here with stocks, but this ratio has really been going sideways lately. Then we look at the long-term monthly chart of the long-term bond here, where we're actually declining and the moving average is going down. And we just started a new month here. And so this just shows that in the long term, the price of the 30-year bond continues to go down. And then we look at a ratio between stocks and commodities where this KST, which is a long-term oscillator, it's still continuing to go down. Then we look at the different sectors. First, I look at the sector all by itself. Materials, which got hit with everything else, they've been bouncing back, but can't seem to get above their 200-day moving average and underperforming when we compare it to the S&P. Communication, a growth area, an area that actually held up quite well even when we were going down. It's been doing quite well lately, and it's outperforming the S&P. It never did go into a downtrend, even when we were declining here. It went down like everything else, but it held up better during that time. Energy, which is in a downtrend, can't seem to stay above its 50-day moving average, and also underperforming. We were starting to generate a golden cross here, but then this ratio really went down, and now we've seen a death cross with this ratio. Financials, banks and insurance companies and so forth, they're holding up fairly well, and they're one of the better performing areas compared to the S&P. They did fall back, but they're still in a longer term uptrend. Industrials, which tend to mirror more what's going on with the economy, really coming on strong here lately and just about ready to generate a golden cross and actually outperforming when we compare it to the S&P. The tech sector in a downtrend, but really improving here and above both moving averages. And it's in a downtrend, but it's above both the moving averages here with this ratio. Staples, which toilet paper and toothpaste, tending to chop more or less sideways right now, but still in an uptrend. But now, even though they're in an uptrend, they're showing how they're underperforming the S&P. Real estate, really struggling when interest rates go up, just chopping sideways at best right now. Can't seem to get above its 200-day moving average and is in a downtrend and back to underperforming, even though it's hanging on to an uptrend here when we compare it to the S&P. Utilities, they've been hanging on, going sideways for the most part and trying to go up here. And then they're in an uptrend compared to the S&P, but really have been pulling back lately and starting to underperform. Then we look at an S&P to utilities ratio. I haven't been showing this chart all that much because we go up a little bit, down a little bit, up a little bit, down a little bit. We want to see more continued upward moves. That means the S&P is outperforming utilities. Then healthcare, which is more defensive, in a downtrend here and back to underperforming the S&P. Discretionary, still above its 200-day moving average, but in a downtrend, and it's underperforming when we compare it to the S&P. It's really been having some trouble. in 2025. Then semiconductors, we're above both of the moving averages, but we are still in a downtrend. Here's the Dow Jones Semiconductor Index in a downtrend, but above both moving averages. Then here's the semi to tech ratio, which I showed earlier, so I'm not sure why it's here now. But in case you missed it before, we are improving with this, but not really breaking out. This is a ratio from semiconductors, which are growth, to the Dow, which is value, even though there are growth stocks in it. We are improving, but we haven't really broken out above these series of lower highs here with this ratio. Then this is a long-term look at the SOX index, which are semiconductors. We broke down all the way below the 200-week moving average, and so far we've been coming back up, even though we've been chopping sideways lately. Here's the intermarket analysis chart. Even though gold has been coming down, it's still the best performing asset. Stocks are now in second place, followed by commodities. Bonds have now shifted over to negative based on price year to date, where oil has been coming back up. And now we have the dollar, which is the worst performing asset currently in 2025. Then we look at some correlations. We look at stocks to the dollar coming back up and actually getting closer to neutral. Not really getting any insight there. And then stocks to oil, they're having a tendency to go in the same basic direction. They both have been going up lately. And then stocks to the 10-year yield, coming back up into neutral, but a slight tendency to go in opposite directions. And the tech sector to the 10-year yield, also a slight tendency to go in opposite directions as well. And now neutral when we look at stocks to the 2-year yield, where they were going in opposite directions, and now we're seeing them tending to go more in the same direction. Then some long-term charts. This is a monthly chart of the NYSE. We came down. This longer-term 12-month moving average did hold up, but we're still going down on the momentum when measured by the Kopic curve. We are showing a little bit of an improvement here with the NYSE record high percent index, so it's bouncing up lately. And then we look at another monthly chart with the Kopic curve where it's still rolling over, even though the NYSE has been starting to go back up. Then the S&P with the PPO, it's trying to turn back up here, and it's above its moving average again, so it's improving, but it hasn't switched over to positive, at least yet. And then we look at the ratio between stocks and commodities longer term. This ratio still continues to go down. And we look at another ratio of stocks to the global stocks, where we're still hanging on to this 12-month moving, this is a 24-month moving average here, but the KST is continuing to go down. With each video and course, members learn to implement the consensus approach, a unique analytical method. Unlike relying on a few indicators that eventually fail, this approach overcomes analysis paralysis by using the weight of the evidence to draw conclusions. Developed over decades across all market conditions, explore the SPX investing program and start with a 30-day free trial. Then at the end, we list those things that are positive. We have copper, which is positive, the euro, pound, and yen when compared to the dollar. The CRB index, gold, and silver are still in uptrends. The low volatility ETF, chopping sideways, but in an uptrend. Staples, and then bonds based on price. The total bonds, high yield bonds, investment grade bonds, junk bonds, and the world bond index. The FANG index, that was off the list. Now it's back on the positive side. And the high leverage loans, that bodes well for the economy. Emerging markets are in an uptrend, and Bitcoin is in an uptrend. And then we look at the negative side. We look at the growth and value indexes all by themselves. They're still technically in downtrends, where the mega caps are in downtrends but improving. The US dollar index is in a downtrend, as are corporate bonds. The Dow Jones Composite, tech sector, a lot of these are improving, but they're still in downtrends. The semiconductors are still in downtrends as well. And then the Dow, the NASDAQ 100, NASDAQ mid caps, small caps, and micro caps. So everything's still in downtrends, but really improving. And most indexes are above both of the moving averages that I use to measure whether we're in an uptrend or downtrend. And the NYSE composite is in a downtrend as well as the Wilshire 5000 and the total US stock ETF. And then ARK continues to be in a downtrend, and all stock. Nope, all stock should be on the nope, they're still in a downtrend. Okay, sorry about that. So thank you. I hope you found this helpful. I hope you have a wonderful weekend, and I will talk to you in the next video.